trading, and there's a danger there. You've got to find the balance between trading something that suits your personality and just trading something because it feels easy to you.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders podcast.
Welcome to Two Traders. It's Walter here. Hey, Darren, how are you?
I'm very good, Walter. Nice to speak to you again.
Yeah, great to hear from you. So Darren, I have this idea. The idea goes something like this, and I'd love to get your thoughts on it. It is that there's this so-called secret to trading, right? It always sounds better when you say secret. And the idea is that you, like an airplane or an airline flight, the really tricky part, if you talk to any pilot, they'll tell you that the really dangerous parts are when they take off and when they land. And in the middle, it's not that big of a deal. In fact, I think with the modern airlines, they don't even, like, the pilots don't really do much. It's almost completely on autopilot for most of the flight, which a lot of people don't know. So, taking that analogy across to trading, you say, is it true that if you can just navigate the takeoff and you can just work your way through the landing, that the middle part of your trade is actually, there isn't really much to do there, or it's at a minimum, it's the easiest part of the journey when you look at your trade this way. So I'd love to get your thoughts on this, and whether you agree or disagree, or if you think it's a little bit off. But I thought it was a really interesting analogy.
Yeah. Well, it's really difficult to pin down the important parts of trading in that respect, I think. You could argue that there are key decisions that are important, and then there are other elements which really are out of your control anyway, and your decision's not going to make much difference. And I think those elements might be, say, something like, let's say, the discretionary part of your exit, where you have to use some analysis and decide whether, let's say you've reached TP1 and you need to make your system says at this point you make a decision whether you go for TP2 or you close the trade or close part of it. And I think those kind of decisions that are based purely on analysis, you could say that they're like the middle part of the flight. Really, over the long run, there's going to be a lot of luck involved in those decisions, and you don't really have that much control over the outcome. And I suppose then you could say that the important decisions, like the takeoff and landing, would be those elements that keep you in line with the part of your strategy that creates the edge. And so let's say, for instance, making sure you hold your trades to the correct TP and not closing them early, and likewise with closing out your losing trades. So I think in that respect, there are important decisions that will have a determining effect on your results over the long time. And then there's others where you don't really want to beat yourself up about it, because what happens next you don't know, and essentially you need to pick A or B, and you can't really always be right on those elements. So from that point of view, I think there's similarities there.
Right. So the way I look at it is, I was thinking about this and I thought, well, for some traders, you might argue that the takeoff and the landing are almost blended into the same thing. Like they're not quite, but almost the same decision. And in other words, at some stage, for some traders, what happens is they're in the trade, and the decision to take off, or the beginning part of the trade, which is basically when you place the trade or you place your order, you get in your trade, you pull the trigger, you're in. At some stage, that switches over to, it shifts to managing the exit, right? And you could argue that as soon as you're in the trade, really you've gone to exit mode. How do I manage this, getting out of this trade? I mean, you could argue that that's the best way to approach a trade. Do you know what I mean?
Yeah, I suppose so. I think really a lot of trading strategies will already have a determined place where they get out of the trade. So essentially from the entry to the exit, there's not really anything you can do. I think it's unusual for a strategy to have, then do more analysis as time goes on. So yeah, essentially really you should step away from the computer then, unless you have a strategy that says you have like an ongoing analysis, and that's where you decide on your exit point. I'm not convinced that's a particularly good way to go about it, though.
Yeah, right. So yeah, I'm with you. So let's say, okay, let's take this hypothetical trader. He has a system where, and let's say he uses like a breakout strategy, and he watches the market or he doesn't watch the market during the Asian session, and as soon as the London market opens, he looks to take a trade. Okay, so he's looking to capitalize on the volume that floods in, in the early European market. And so our trader buddy, he uses a trailing exit. Okay, and so what he does is he just kind of waits for the market to go, and he doesn't have a TP, so doesn't have a target in mind at all. All he's doing is he's managing his trade. And let's say, for example, he takes a trade today and the market breaks out of the Asian box, so to speak, and trades higher. And so he goes long the pound in this case, the pound against the dollar, and he's long, and so all he has to do now is manage his exit, and his trailing exit is to simply trail and put a stop loss. His stop loss is just meant to trail underneath all of the little local lows. So like Bill Williams would call that like a fractal or whatever, but it's basically like a little low, like a little low. And so every time the market makes a new low, he just kind of moves his trailing exit up and locks in more profit until he gets stopped out. So in that case, to me, maybe I'm looking at it. I think I'm looking at it differently to the way you would. But in that case, all he's really doing from the moment that he takes off, okay, as soon as his trade is triggered, all he's really doing is managing the landing of that trade, and he's doing that by simply trailing his exit manually, right, waiting for these little lows to be made, and he's hoping that they're higher lows. And once in a while he's really happy because he has this amazing trade, but a lot of the time, he gets stopped out with a small or medium-sized win, and he obviously takes his share of losers as well.
And I suppose in that example, an example of the part where he's essentially in the middle of the flight would be, say price raced much higher really quickly. He wouldn't then change his landing part of trailing his stop just because something slightly unexpected happened. He'd essentially that bit would be on autopilot, and he would ignore anything else that happened.
Yeah, and he would hope that there would be another local low that's made up way up there, up higher, so that he can lock in more profit. Yeah, exactly. Yeah.
So it's like there's certain elements of trading strategy that should be adhered to, because over the long run, it's those elements that make us profitable, and regardless of what happens in between, as long as we take care of the takeoff and the landing, then we should be all right. And the danger comes in that we start then considering other elements to be important in the moment.
Yeah. And I think they creep in, don't they? Like, you can think of things like, for example, I had a trade on, and it was on the pound yen, and it was during the UK, the day of the UK elections. And normally, and I was over there in London, and normally what happens is, in the evening time over in London, it's the Asian session, and there isn't a whole lot of action. But what happened was, I got slipped on my trade. I got stopped out, and I lost a lot more than I had a lot more than I had calculated because of the slippage on that pound yen trade. It was a loser, and it was a bad loser. But things like that happening when you're in a trade can make you reconsider and go, oh, well, next time I'll do this or whatever. And you sort of, that's how I think mistakes are made. You know what I mean? So I don't know that it's necessarily the case that it's always so automatic during the middle part of the trade, because I could see where, like for your example, like you're saying, the market takes off, and then what does our trader do? Does he decide, well, it's gone up 100 pips, but it hasn't allowed me to move my stop loss, so am I really going to give it 120 pips of cushion here, or should I move it halfway up and take another 60 pips profit here in case I do get stopped out? How do I deal with that? I think that's a good point. I mean, unless you have it fully automated, like a trailing exit fully automated where you don't have to manage it, it's hard not to have things like that sneak in. It's hard for me to go back and take another trade when there's impending news or whatever, knowing that last time I did that, the market fell because, they said, oh, we don't know what the election results are going to be. And so the pound really fell off the cliff that evening during the Asian session, no less. So, there are these things that happen in trading that make you think that you need to add rules. I don't necessarily think that's the case, but I think that it kind of goes against this idea that we're talking about here, or that we introduced, which is the middle part of the trade is the easy part, and maybe that's not the case.
Yeah, well, the interesting thing when we're comparing it to fly-in is that pilots that have had lots of training, lots of experience, they still have checklists of the important elements that have to be done every time they take off and every time they prepare for landing, and no doubt throughout the flight as well. And so obviously it's kind of it's something in us as humans to kind of not find it easy to stick to these simple processes. And they've deemed it necessary that when flying a plane, you may have been flying a plane for 15-20 years or whatever, and the process to go through, but you're still going to have a checklist there to make sure that you get the important elements right each time you fly. And I suppose, those elements aren't going to protect you from everything that could go wrong, but they've been deemed as the important elements, and I think you need to do that for your strategy. You need to break down and find out what is the core reason that your strategy makes profit over the long run, and you need to make sure that those elements are protected. And also it's important to realize that there's elements to your strategy that, although they might feel important, don't really make a great deal of difference to your profit over the long run. And those are kind of things that we slip in as kind of curve fitting. Maybe you have like one particularly bad running period and you'll decide to try and tweak your rules so that doesn't happen again. And those rules will feel significant as well. But over the long run, if you'd have just taken that losing period for what it was, bad luck or bad market conditions, then you might not have made those changes to your rules, and you likely would have made more profit over a long period.
Yeah. So how do you know? I mean, I guess for the trader listening, how does the trader know when they are curve fitting? How can you tell? Like, what's the test?
It's very difficult to know for sure, but generally curve fitting rules will improve your performance over a small sample. But if you stretch it out over a larger sample, if it's still making a positive effect, then you're not curve fitting. But if it's only significant in a small sample, then that's just probably luck and curve fitting that's going on. That's how I see it anyway.
Yeah, and that's how the algo guys approach it too, right? So they'll like they'll use different samples and stuff when they're testing, which you can do that as a discretionary trader too if you're running through Forex Test or whatever.
Yeah, I mean, because you don't want a strategy that made 10% last week, but over the year lost, blew up your account. You want something that made a profit over the whole year, and it didn't matter if it lost some money last week. That's essentially what we all are looking for, unless you're just looking to double your account in 1 week and stop trading, which I don't believe we're aiming for.
Yeah, exactly. Yeah. I think for me, one of the things. So I think we can say that it's not as smooth sailing as it seems at first glance. Like the middle part of the trade can be kind of tricky, and I also think that we've talked about this before, but I think we're built to lose money. Like the average person, the vast majority, the huge majority of people who participate in the markets are built to lose money. And so, and that's not really a slight against you or me or anyone else listening to this. It's just way we're built. That's the psychology, yeah. And so when you have this brilliant light bulb moment, and you think, okay, this is what's been happening to me, so I need to add this component to my trading system. That's like, it's the road to hell is paved with good intentions. that's like the sign that, yeah, okay, all right, to me, that's how I see it, and that's why I think, fewer moving parts, the simpler the better. All those things move you further and further away from curve fitting. The problem is that some people think it's too simple, and that there's no way that something like that could work. I mean, I've heard of systems where it's like literally like people buy the market at 5:05 every day, and that's the system. It's like these really simple systems that have been developed, and people think there's no way that can work. Why would you? Well, like, you don't even take into account the trend, and you just buy every day at 5:05 p.m. or whatever. Things like that. But those things, to me, make sense that they would work, because everyone's looking for the more complex, and they're all adding more elements to their systems, and I think that's why I want to get further and further away from that. I don't want to do what the crowd's doing, I guess. And I know you're the same way, really.
Yeah. I mean, whenever we have to appreciate that traders in general are highly skilled now, and they're highly educated, and we all have access to the same information, essentially. It's not like it was a long time ago when information was just there for the wealthiest. With the internet now, we can all access that information. We can all gain the knowledge. The knowledge is all there for us to gain. So I think the amount of skill in the market is much higher, and so you need to have something slightly different that's going to give you the edge. And if you just believe that somehow you have some sort of particular skill or ability that the majority of traders don't have, then you're going to be disappointed, because there's a lot of skilled people out there trying to make money at the same time you are. So you need to some sort of flanking move, a different approach to attack the market. And if you look at how you're trading and it essentially aligns with what everybody else is doing, but you still believe that you're going to be successful even though they're not, you've got to ask yourself why that is. And if you're honest with yourself, you quickly realize that you need to do something different. So, if everyone's closing their trades early and everyone's letting their winners, their losers run against them, then you need to make sure that you're not in that group. Do you see what I mean?
Yeah. And if everyone's looking at that really strong move up and thinking, okay, I'm going to find the reversal point, then maybe you need to just assume that it's going to keep going up, right?
Yeah. And generally when you look at the retail crowd, we tend to lean towards smaller risk to rewards. They tend to be going back to your point about us not being natural traders. We all tend to lean to what feels more comfortable and what feels right, and what we can deal with. And this is part of the problem with the notion that you need to find out what sort of personality you are and trade in a style that suits your personality. And although I 100% agree with that, what you need to be wary of is just picking all of the things that feel nice. Because you tend to do that with trading. You'll look at a trading system, you'll start testing it, and you'll think, I just don't like letting my winners run, so I'm going to go for a smaller profit target on this and use the same system. And you find that you'll tend to do that with all of the elements, in the belief that you're making the strategy work with your personality. But a lot of the time what you're doing is you're just removing all of the elements that feel uncomfortable to you. And I really strongly believe that the best trading strategies will suit your personality, but there will still be elements there that feel uncomfortable. And you're better to find a way of dealing with those feelings and emotions of being anxious or uncomfortable, or you could even say it was painful, you're better to find processes to deal with that than trying to just remove all of those elements. And there's a danger there. You've got to find the balance between trading something that suits your personality and just trading something because it feels easy to you.
Yep, and I think that would make a very good episode, actually, to talk about that comfort level, where it comes from, and where exactly you need to challenge yourself. That's something that I've been thinking about, and I really think that would make a good episode. Yeah. Okay. Well, thanks for your time, Darren. We'll see you next time.
Cool.
Thanks.
See you soon, Walter.